Okay. If you can hear me, please put a 1 in the chat. All right, so today we're going to be covering the Greeks. And then immediately after that, we're going to just go into question and answer. We're going to try to keep this very short and sweet, straight to the point. I'm going to try to get through the Greeks in about 10 minutes because we know that a lot of people have been asking a lot of questions in the Discord. And so we just want to make sure that we're giving you guys the attention that you need for, options trading related topics. All right. So just a little bit about myself. My name is Kayla. I go by ICurlyCae on Instagram. I am a mother of one. I am an executive account manager, been at my job for about 13, 14 years. I am a recent cosmetology grad as well, and options trading admin, a Florida resident, as well as a yogi. And typically when I do presentations, I like to include something that's relative to the topic. So since we're talking about the Greeks, I put in Socrates, wisdom begins in wonder. And the disclaimer, I am not a financial advisor, and this is in no way financial or trading advice. I am simply sharing options trading strategies that I use and have been successful with in the stock market. And this presentation is for educational purposes only. There are significant financial risks involved with trading, and I am not responsible for your losses in the market should you decide to utilize the information and/or strategies discussed within this presentation. By choosing to proceed, you are acknowledging your understanding of this disclaimer. And then one other thing, before we even get into the Greeks, I want you all to know that I'm going to give you a very book-like version or breakdown of what the Greeks are, because obviously I need to make sure that I'm educating you all the right way. But then I promise you, I'm going to pull up an example, simplify it, show you how to read it on the chart so that it makes sense to even a 10-year-old. So just bear with me, bear through the talking if you can, all right? All right. So delta. Delta is the ratio that compares the change in the price of an underlying asset with the change in the price of a derivative or option. Delta is one of 4 measures options traders use for analyzing risk. Delta tends to increase as you get closer to expiration for near or at the money options, and delta is subject to change given changes in implied volatility. As the time remaining to expiration grows shorter, the time value of the option evaporates, and correspondingly, the delta of in-the-money options increases while the delta of out-the-money options decreases. All right. So here we have an example. This particular contract will gain $45 if the stock goes up by $1. So what you would do, you would look at your contract, find where the Greeks are, simply move the decimal point over 2 times to the right, and you will see that if the stock goes up $1, you've literally gained $45.10. Another really cool thing to know about delta is that delta is relative to the percent probability of profit. So you can actually look at delta to gauge your chances of being profitable with this particular contract. So you have a 45% chance, and not a lot of traders know that. So now theta. This is a long one. Theta is also known as time decay, and it refers to the rate of decline in the value of an option over time. If all other variables are constant, an option will lose value as time draws closer to its maturity. Theta, usually expressed as a negative number, indicates how much the option's value will decline every day up to maturity. The theta value is usually at its highest point when an option is at the money or very near the money. A deep in the money option will have less extrinsic value to diminish because the price will be made mostly of intrinsic value. So the rate of decay tends to be slower. Theta is represented as an actual dollar or premium amount and may be calculated on a daily or weekly basis. Theta also assumes that price movements and implied volatility are ongoing. So the rate of time decay for an option isn't necessarily the same from one day to the next. The rate of theta decay will tend to increase as time to expiration decreases. So in essence, theta decay means you're losing money every single day just by holding the contract. But of course, delta can combat that. So for this particular example, this contract is currently losing, and again, you're going to move the decimal point over 2 times to the right. This contract is currently losing $5 every day. Theta increases closer to expiration and it happens in real time. So you're not going to be able to pinpoint the exact time of day that you're losing the entire $5 because it's going to basically happen gradually throughout the day. Now, the Greeks on this contract look really, really good because you have low theta and high delta. So that's something that you always want to look for: high delta, low theta. Now, gamma. Gamma is the rate of change for an option. Gamma is the rate of change for an option's delta based on a single point move in the delta's price. Gamma is at its highest when an option is at the money, and it's at its lowest when it's further away from the money. Gamma tells us how delta changes given a $1 change in the stock's price. Gamma is always higher with at the money strike prices. So if the stock's price goes up $1, then you would add in gamma. If it goes down $1, then you would be subtracting. So on the left-hand side, if you can see this example, if the stock's price changes by $1, then you would add over here. Here's your gamma. You move the decimal point over 2 times to the right. You would be adding $2.79 into your delta, which is going to bring you to $47.89 if the price goes up by $1. However, if the price goes down by $1, then you would be subtracting $2.79 from the delta, in which it will decrease to $42.31. Now, Vega. Vega is related to implied volatility, how much the value of your option is going to change based on a 1% change in implied volatility. If there is a sudden drop in implied volatility, then you can lose value in your option solely due to Vega. So for example, right here on this contract, you can see the implied volatility is 30.87. So if the implied volatility goes up to 31.87, then what will happen is your contract will gain $18.20. And again, down here is where you would see those numbers. You're just going to move the decimal point over 2 times to the right, and that'll let you know what you're gaining if the implied volatility goes up by 1%. All right, so rho. No one really cares that much about rho, but we have to cover it. Rho measures the expected change in an option's price for a 1% change in a US Treasury's bill risk-free rate. If the interest rates increase by 1%, then the call option's price will increase by, for this particular contract, we're going to go over that. So it increases by 0.25 to 5.25, or by the amount of its rho value. So this particular contract right here, again, you're just moving it over 2 times to the right, and that'll let you know the increase for rho. All right. So hopefully that was short, sweet, and straight to the point. So let's just go ahead and break down what it all means. Delta gauges the likelihood that an option you're considering will expire in the money. Gamma estimates how much the delta will change when the stock's price changes. Theta estimates how much money your option might lose each day as it approaches expiration. Vega estimates how sensitive an option might be to large price swings in the underlying stock. And rho simulates the effects of interest rate changes on an option. And again, just keep in mind, low theta and high delta is what you want. All right. So now we're just going to open it up for a question and answer. And again, this does not have to be related to the Greeks. It could be, your basic questions about options trading, and we'll try our best to assist you and answer your questions.
How we're gonna do it is we're gonna have y'all raise. Can everybody hear? Can you hear me? Can you hear Kay? Put a 1 in the chat. Okay. Well, um, but what we're gonna do is how we're gonna do it to make it organized. We're going to have you raise your hand, and then we'll select you, and then have you unmute yourself. That way, it doesn't get hectic. People aren't talking over each other, and we can make sure we answer as many questions in a productive way as possible. All right. So if you got questions, go ahead and raise your hand, and then we will select. select you, and then have you unmute yourself.
All right, let's go ahead and get it started.
All right, let me see, because it's not popping up all the way on who's, well, it's doing it right here. So we're gonna start with THQ. Um, Go ahead and ask your question. I asked you to ask.
Hey, how y'all doing? Really just had a simple question for the Delta. When you say gauges the likelihood that an option you're considering will expire in the money, what
Mhm.
numbers are we like? Look, is it 0 out of 100? Like, what like number should our Delta be? Like what we looking for to be comfortable as far as number wise.
Well, I mean, you're not using that to gauge your overall contract. You want to look at your everything on your contract, right? But when you're looking at delta, you obviously want your delta to be higher than your theta. So I can't tell you a particular number because your delta is going to vary from contract to contract. But when you do look at the contract, you can at least get an idea from that to see the probability that it's going to be a profitable contract. So I can't say that what you want to look for across the board is something that says 50 because that's never going to be the case for all contracts. The delta is going to vary for every single contract. But of course, you want the higher probability, right? So you want to look for something that has a higher percentage. Does that make sense? Hello?
Yeah. Did you go somewhere, THQ? Maybe it bumped them off or something. I don't know.
Okay.
We're at like a where we're at. Oh, he said yes, it muted you. Oh, I didn't know, bro. My
Okay.
bad. I guess whenever I lowered his hand or whatever. So my bad. Um,
Let's keep it
yeah.
going.
Yeah, I'm trying to make sure I can do it the right way. But yeah, we had 1,000 people.
Okay,
Um,
let's keep it going.
all right. So go ahead, Galaxy S20 FE5G.
Hi, yes. I would like to know how like when you pick your calls and your expiration dates and stuff like that, like say for instance Tesla yesterday, you had a or what that was that the day before, you had a $900 call and 219 expiration date. What made you pick that?
So I didn't necessarily pick that one.
Oh,
However, um, whomever picked it, I believe it was Chris that picked it.
Yeah, Chris.
mm-hmm.
Um, More than likely, he picked it because what he saw on the charts. Um,
Okay.
and I can't tell you what he saw in the charts because I didn't take the Tesla play. I didn't see anything that made me want to take the play. However, we have different trading styles, so he may have seen something based upon his trading style that made him want to take that particular trade. But I do know that Tesla is a very volatile stock, so it goes up really fast and it comes down really fast. It can make a 50-point move, within a matter of an hour or so. So he more than likely saw something on the charts, that made him want to take the trade.
Okay, another quick question. I'm sorry. So it expires next Friday. I still have the contract because I bought it yesterday, I believe.
Mhm.
When is a good day to sell it? Because I know you said every day of the contract expiring, you get closer to the expiration date,
Yes.
the theta goes down or it takes money away
Mhm.
from the contract. So
Right.
like around what day is a good day to sell, regardless of how much money you made or how much money you lost?
So I'm going to preach to you having a trading plan. I'm also going to, if I would recommend using the options profit calculator because by using that calculator, you can actually input the details around your contract, the expiration date, what you paid for, your strike. You can put those details into the options profit calculator, and that calculator will literally let you know by holding it what your contract is looking like if it is trending up or trending down, and it will let you know how much money you will gain or how much money you will lose. So that is my biggest recommendation for anyone that's holding anything that's unsure about whether or not they should hold it or sell it. Please, please, please use that calculator. I'm going to refer you to it every single time.
And where would I find the calculator?
It's listed in Market Facts and Resources, and I believe I titled it, if you're questioning if you should hold or sell, and it has the options calculator within it as well. And that's
Yes,
part of the title.
as well as the video. And then just to pick you back off what Kay was saying, like when it comes to, you know, picking your strike price as well. Like another thing to be mindful of is a lot of times investors and traders like to pick some like multiples of 5 or multiples of 10. So let's
Mhm.
also hold on.
So
Um
basically, you're saying the $900 call, you're saying by 219, the price of Tesla would go up to $900.
Okay, so the strike price, and let's just knock that question out. The strike price is the price. If you were to think of it as a bet, you're basically saying, I bet you that by 219, the cost of Tesla will be $900. And you're essentially associating an expiration date to what you're betting. And if it does not reach that particular price, then your contract will essentially expire worthless.
Okay. So
Mhm.
one other question. I'm sorry, I don't want to take up too much time. So why would we put, like, for instance, in the money? So say if Tesla's is like 850, right? So in the money will be less than 850, but it's already 850. Why would we pick something that's lower, that's saying it's going to go lower than what it is?
Okay, so I think you're confusing. I think you're confusing the entire process. So if you're
Okay.
getting something, if your current price is $850 and you're choosing
Mhm.
something that's $820, you're basically buying intrinsic value. You are trying to be on the safer side of your contract not expiring worthless.
Okay.
That's not 100% guarantee. It's just a lower risk because it could fall below that amount. And, and then you're pretty much AO'd, right?
Yes.
Out of the money gives you a higher percentage gain. It doesn't have a lot of intrinsic value. It doesn't have a lot of value within. So playing out of the money could give you higher percentage gains. You can also see yourself making money even if it hasn't met that strike price, simply because the cost of the premiums begin to change as it moves towards that direction.
Okay. So it doesn't have to go to 900 in order to make money.
It does not.
no, it
Because
doesn't.
as the prices go up, as more people start to look at that contract, as more people say, hey, this might be worth something, they may actually cause the price to go up just because they're starting to buy in. So now it's going to be worth more.
Okay.
And you make money off of the run up in the premium changes.
Thank you so much. So that's why. So another thing, I'm okay. Never mind. I'm sorry. I don't want to take up too much time.
So you have us in the Discord where you can message us.
Okay.
We want to be fair to everybody, but just
Okay.
message us, and we do a really good job at responding.
Thank you so much.
No problem. Thank you.
Bye, Chris. Thank you.
All right. Next person we're gonna have is Daniel Alexis. Go ahead, unmute yourself.
Hello, how you doing, y'all? I had a question about the whiteboard magic.
Mhm.
So, basically, when I went on it, I seen like a bunch of different platforms. So each platform has a subscription that you have to pay for in order to get like the top news or like the top. Because when I went on, I think it was the tip ranks. I
Mhm.
seen a couple of people, but all of their ratings were like 60%, 70%, like very low ratings. How do I get to like, one of those guys that I seen on the whiteboard magic?
Okay, so unfortunately, I don't know what you're talking about because I haven't taken that particular course. This is more for the options and
Yeah.
Oh,
the whiteboard. If I'm not incorrect, is for trading stocks.
no, I actually said it's for both, like options and stocks, so that's why.
Ray, do you
I
have
asked.
any information, or maybe that probably would be a question that's better answered by Chris?
Yeah, it
Oh,
probably must definitely be answered by Chris, but a lot of that is just doing your due diligence and doing the research that he does and what he teaches you in that course to be able to make those plays. But at the same time, those plays aren't gonna always happen. Like you ain't gonna always, hit those high percentages and stuff like that. So um don't have unrealistic expectations, but it's definitely a lot of research that goes into it. So that's
mhm.
the short answer. It's definitely a lot of research. Like it's not, it seems simple, but it's not simple. Chris makes it look easy, but it's not as easy. Like he put hours and hours into research. And that's what a lot of people got to understand. Like you got to research a lot of these companies and see what they're doing, and then develop your own strategy and stick to it, and don't constantly swap your strategy just because you have a losing play. You know what I'm saying? Like losses going to happen. Specifically with options, losses will happen, especially if you don't buy the right contract, if you're hopping in other people's plays, you didn't look at the chart for yourself. You know what I'm saying? Those things will happen. So don't think that you'll ever have a 100% win rate or anything like that. The losses will come. And it's just about doing the research and not getting down, just staying confident in yourself and in your process.
Thank you.
No problem. All right. Next person is Alexi Kim. Go ahead and unmute yourself.
Hey guys, thanks. So I guess I had a question to add on to the lady that was before. She asked about the Tesla contract. What I'm kind of wondering if you can expand on is what makes you choose a certain contract over another one? Like there's, many different options for many different days. What makes you choose a particular option of like, let's say like $900, Tesla? Is it you looking at theta and gamma? Are you looking at the volume of it? Like what would you be looking for?
Really
I think
good
for
question.
for the most part, what is going into a lot of people's process, you know what I'm saying, the ones that feel comfortable with doing call outs and stuff like that, is one, especially with Chris, like he uses flow algo. So that contract may have popped in flow algo, and what flow algo is it's options flow. It says, sometimes they'll beam like somebody bought like $1 million at this expiration on this strike, you know what I'm saying, today or whatnot. So a lot of times people would piggyback off of, that high buy on that strike price with that expiration date. The other thing is people like to select contracts in multiples of 5 or 10, as well as you can look when you're going to select your contract, and it's ideally around the place where you think that the stock will move to, the company will move or not. It'll have high open interest or high volume. So what's going on is people are picking the best strike with the best volume. So if I'm looking at, let's just say, March 19th expiration, right? I'm going to look at all those contracts. I'm first going to look around where I think it might move, but then I'm also going to look at, okay, what's the open interest, what's the volume, what the Greeks are looking like. And most of the time, wherever the high open interest and volume is, the one that has the most, those Greeks tend to always be good anyway. People are going to always try to find the same contract and pick the best. So most of the time, those people gravitate to the same place. So that's a lot of what goes into it, besides, doing the research, seeing what the company is looking like and all that other stuff. So does that answer your question?
Yeah. So where do you do you recommend a certain app where you can see like the volume of the contracts? Because for example, I use Robinhood. Don't judge me, guys, for option trading.
We won't.
And you have to go one by one to kind of like see which what volume is like in for every option. Is there like a platform that kind of lets you see like volume easily?
Yes, you can use, there are a lot of different screeners and scanners in there. And then also, I'm going to tell them to you, but if you forget, they're also listed inside of Market Facts and Resources. You can use Flow Algo, you can use Finviz, Scans, you can use Benzinga. Some of these are paid platforms, but it lets you know who's looking at what, how many people are looking, where the volume is. So if you just get familiar with scanners and screeners, then you'll be able to, see exactly the type of moves that Chris is viewing, where he can actually call out those plays because he sees there's a lot of people looking at this particular contract. Does that help?
Yeah, I got to unmute him again.
Okay.
Yeah, gotcha. Thank you so much, guys.
No problem. And then also, before the next person asks a question, I need everyone to know that your volume and your open interest are extremely important. Your volume is going to be the amount of people that are currently trading a contract within that particular trading day. Your open interests are the amount of people that are currently holding that contract. And I want you guys to be familiar with this, because if you don't have any volume or open interest on your contract, and even if you're profitable and you try to sell your contract, If you don't have anyone looking at it, you have no one to sell it to. And I've had a few people to message me about that, direct message, and even options beginners, because they're stuck in a contract. They can be profitable, but they're stuck because they have no one to sell it to. All right, so we can go to the next person.
As well as don't try not to hold your contract to the date of expiration, because 9 times out of 10 on expiration date, it's going to drop down to 0.01, which means it's worthless. So you don't have to hold to expiration, and we recommend you don't hold to expiration, because that's what's going to happen to your contract. And you're going to be like, why I can't sell it? And it's because it's worthless. Nobody wants it because it's going to be 0.01.
And just to clarify that, he means if it's trending down, it's not going in the direction that you wanted to. Not if you're profitable. If you're profitable and you want to keep holding because you know it's going to just go up on expiration, that's completely up to you. But you want to try to mitigate your losses, cut your losses as early as you can, and use the options profit calculator, please. All right.
Next person is like Pray Yush, or I don't know how to say it, but yeah, go ahead, ask your question.
Hi, thank you for all the information. So with all the stocks and I mean, it kind of piggyback on the previous question too. With all the number of stock tickers around, with all the number of option chains, what is the best way to drive it down to a few number of plays, like in a single digit plays? Obviously, as a human, you cannot
Right.
go and fight with like tens of tickers or tens of option chain. So what is like humanly possible way? I'm trying to narrow it down over.
So that is a really good question. So there is a few things that you can do. You can actually decide on companies that you currently are a consumer of. If you shop with a few companies, you spend a lot of money with the same companies every month, you can start by learning how to trade them. And you can be profitable by trading the same 5 companies over and over. You can do calls on the way up, puts on the way down, and you learn them intimately, and you can just make money, just a rinse and repeat process. You also have the option, as what we were stating before, to maybe invest in a scanner. There's some free ones out there, but obviously the ones that you pay for give you better information. You can do a scanner, and you can narrow your view down by sectors. So maybe you want to trade in electric vehicles, or maybe you want to do pharmaceuticals, or maybe you might want to look at the weed stocks or something like that. You can narrow your view down just by the sector. And then the other option, which I'm not that big of a fan of, is trading earnings. You can look at earnings calendars at companies that post their earnings. Calendar would be Option Swing, or what's the other one, Ray? It's losing. I'm losing it. Option Swing and Earnings Whisper. They post their weekly calendar of all of the companies, or a few companies that are going to be releasing earnings, and you can position yourself into some trades by actually trading earnings. So that kind of narrows it down, because there's so many companies out there, but that should help you.
I don't even see where you went. I was gonna, because it automatically mutes them back. So let me allow them to unmute themselves. So but yeah, hopefully that answers your question.
Thank you
Okay, great.
for that. And that's applicable for the stocks. And how
Yes.
about how do you narrow down for the options? If you
It's
can go over that one also. Thank you.
It's the same exact mentality. You can narrow down the sectors. You can look at the calendars. I mean, it applies both ways. Your technical analysis obviously would be a little bit different for entering to options trades versus trading shares or stocks, but it would be the same exact thing. The same exact mentality of how to find the trades would be the same thing for either side.
And I ain't speak to you yet.
Thank you.
Bruce, please mute yourself.
Oh, sorry.
All right. Next we'll have Santiago. Go ahead, unmute yourself, ask your question.
I thought that was my car. Like my car's not that clean.
All right.
Bruh.
All right, everybody. Could you mute yourself?
All right, Felix, go ahead and go with your question. Okay, I guess maybe he's gone. All right. Max's iPhone, go ahead. Unmute yourself.
Hello, I had a question about the indicators, not really about the Greeks.
Go
I
ahead.
was watching the video last night and I had a question about the Stoke compared to the MAC. I noticed looking at the charts, they look very similar, but I know they're different. Do they like go hand in hand?
You can definitely use them together. You're talking about the stochastic RSI?
Yes.
Yes, you can definitely use them together. They are very different. The stochastic, it basically is kind of like the RSI. The only difference is that, or one of the differences that, something below 20 is ideal to buy in for calls, and above 80, of course, would more so be puts, or, your overbought and oversold conditions. But you can use those hand in hand. Your MACD obviously is going to be a completely different technical indicator. So yes, they can be used together.
Awesome. Thank you. Thank you.
No problem.
All right, London Bright. Go ahead and ask your question.
Hello, thank y'all for doing this.
No problem.
My question was, what is a good spread for the bid ask? Like, is it 1% of the value of the stock, or I'm not sure how to gauge that.
That's a pretty good one, but that's a question that is going to be stock specific, right? You might have a stock that has a dollar spread between the bid and ask, but it's just going to be contingent upon the stock and how the stock actually moves. But if you see something that is going to have you trapped, like a stock that has a very wide, $50 spread between it, I wouldn't encourage getting into that particular contract.
Okay, gotcha. Thank you so much.
No problem.
All right. Go ahead. Hold on, let me mute everybody. All right. Okay, go ahead and unmute yourself.
All right.
And Rosa, you can go ahead and ask your question.
Hi, sorry. So with the Greeks, before you buy the call option, are you allowed to see the Greeks in
Yes,
the because I have Robinhood and I noticed I'm not able to see it until after I buy the call.
you just gotta click on I forget
The
specifically.
bid and
what
the
it is.
ask.
Yeah.
When you click on the bid and the ask, like right before you get ready to purchase, it'll pop up.
Yeah, and it'll show you the open interest and all that stuff on it. So that's how
Yeah.
you access it. You don't have to wait till after you buy it to see it. So yes, you can see it before.
Okay, thank you.
No problem. Jordan, go ahead and unmute yourself and ask your question.
Hey, sorry, I just want to make sure I'm unmuted. My general question was, sometimes Chris, I apologize if this is already answered, but sometimes Chris calls out to play and be like, yo, hey, it's this company at this strike price, this expiration date, and then buy here. And literally, like, from the time that I see it to the time that I'm going into the app to basically play the same play, like the premium has changed. I'm like, fuck, So I'm just like, do I, in that case, if he's like, yo, buy, and it's just, for example, buy at $3, and when I look in the app, it says, well, it's $3.05. Do I just go up to, just try to get the closest to what his play was? Or I'm just trying to figure out in what scenario do I go, you know what, this is already taken off too much, don't get into this, or I'm kind of close to where he's at, I can jump into this and still make profit.
If you just seen it, like, and it's literally only been a minute, you can go ahead and still hop in. Like, the price of the contract is changing. A lot of stuff, sometimes it might take a day for the play to happen, or sometimes it never happens. But sometimes when Chris sees a play, it's taking off immediately. So you just gotta like jump in with it. But like if you 30 minutes to an hour late, then it's kind of like you would need to do your own due diligence at that point, to me. But if it's within like 5 minutes or 3 minutes of him calling out, then you kind of go ahead and good to go ahead and hop in it. But still, we encourage y'all to learn how to do this stuff on your own, so that way you can verify and try to see what he's seeing, but also at least see something in it. So that way, if it goes the other way, you won't panic sell, or you won't just buy into a contract and it's already losing. You know what I'm saying?
Yeah, because I think previously within the last maybe 48 hours, I forgot what stock it was, but he was like, look, we're up 20%. And I'm like, where? Because I'm down. And everyone in the chat is like, I'm up, I'm down, I'm up, and I'm down. I'm like, and he's like, yo, if you're not up, then you shouldn't be trading options. I was like, God damn, yeah.
You asked my favorite question. And so I'm going to go a little bit deeper with that, okay? Because I know you guys have seen me. I'm not yelling in the chat when you see me writing all bold, but this is something that I really, really am passionate about, because it makes a difference in whether you versus the next trader are profitable or not. So when you're seeing somebody saying, I'm up, and you're like, I'm in the same exact thing, why am I down? Think of this, and I literally put this into the channel, so I'm going to read it to you. If Chris calls out a play and he alerts an average cost or premium at $1.50, and you're late entering and you chase the trade and you enter at a higher cost or premium like $2, you've essentially paid $50 more, because when you think about it, Chris paid $1.50. You paid $2. Contracts trading 100 shares, right? So you're multiplying it by 100. So you've already paid more. So let's just say his entry was $1.50 and you get in at $2. If the stock has gone up to $2, he's already made $50, but you haven't made anything.
Exactly.
So if he sees the stock reversing, he can sell it and maybe sell it at $49. He could sell it at $48. He's gonna take his profit. But guess what? He's profitable, but you're not, because you bought it at $2. So that makes a very big difference. Your entries matter. Everyone needs to understand that. That's an amazing question, and you are my new favorite person to Jordan.
Cool.
All right.
Thank you.
You're welcome.
All right. Alex Torres, you can go ahead and ask your question.
How you guys doing?
All right, how are you?
Hey, I just wanted to ask, do you guys ever plan on touching other option strategies like iron condors or butterfly spreads? Because I would like to be educated on those as well.
Absolutely. We are in the process, because obviously the Wealth Squad is, a new family that's just been built. We are trying to build up the fundamentals, and we're still being, and it's nothing wrong with it. We're still being asked the basic things. So we want to make sure that we're catering to the people who are beginners, and we're going to build up there. We're getting to that point. We're constantly putting out new information. So to answer your question, yes. And he asked about more advanced strategies, you guys. I see people saying they couldn't hear you. He's asking about, spreads and iron condors and other trade. Yeah.
Wheel strategies, stuff like that.
Absolutely.
All right, Dimitri Reese, go ahead and ask your question.
Yeah, hey, how you guys doing? Thanks for the info. So one quick scenario that I had, trading on an option. So of course Sundial ran up. So I thought, since I watched the RSI run hot, I was like, I will put a
question. But like I said, I apologize as a provider, as an admin. We shouldn't let stuff like that happen. So we will make sure it doesn't happen again. And like I said, I apologize to anyone that was disrespected. Like I said, apologize again. Because we don't tolerate energy like that. And I'm sorry that has, shifted the energy of this call. Hopefully we can just put it behind us now and move forward. And like I said, I sincerely apologize.
No, all good. Dimitri's still here. Can't control everyone. Just got to do your best to control the situation. And I think you did that. Yes. We're all here to learn, get money, get paid. So
let's keep it going. Yeah, thank you.
Go ahead and ask your question, because it left my mind.
For sure. So can you guys still hear me?
Yeah, we can.
Perfect. So I put in a put on Sundial when I saw the RSI running high. It did begin to drop, but for some reason, when it was dropping, I was still losing money. So maybe there's something I didn't understand or something about the put I did probably wrong. So I was trying to understand that. Is that a case you ever seen or heard before?
Hold on one second. Let me mute some of these other people. All right, so you're saying that you put in a put, and what was happening again?
Yeah, so I put in a put. It was like around, the price was around like 290 or something when I put the put in. I checked back later. The stock was then trading around 225. So I'm like, all right, I put the put in, so that should mean a profit for me. But I still was losing money. I lost like a couple bucks, like 50 or 100 bucks, and I didn't understand that.
Sometimes even if the price is going down, there's not enough volume or volatility in it to move the contract. Because like, all right, we talk about theta decay. All right, so
Right.
that's the longer you hold it, it value leaves every day. But sometimes your contract isn't moving or um it's losing value because of the implied volatility. So like when you hopped in, like let's just throw out 150, the implied volatility might have been 150, right? Because that's what Vega handles, right? So let's say it was 150, but now it's 100. That contract isn't moving anymore like it was. Like the volatility of it moving was why puts went up, because if a stock goes up high, now everybody's thinking about doing puts. So it's gonna make puts value go up a little bit. So that's the other aspect of the contract that we often forget about, is the implied volatility, and that oftentimes affects our contract and why it doesn't move. Because like let's say you buy a contract, right, and that stock traded 1,000,000 times that day, right? But then the next day it only trades 100,000 or 500,000. There's no implied volatility there anymore, really. So that's also messing with the value of the contract, because if it's out the money, that's the extrinsic value. It's time plus volatility, basically. So does that answer your question?
Yeah, it's kind of, for me, full transparency, like a clear as mud type thing. So I'm going to do a little bit more research.
Yeah, just whenever you're looking into that stuff, especially when you're hold on.
Please,
Please mute yourself, because it's kind of hard for me to do it. All right. Look into how much that stock usually trades. That's why a lot of times all right. Everybody's finna get muted for a second. All right. Nobody's gonna be allowed to unmute themselves. All right. So when you come up here and I have you unraise your hand, make sure you comment in the chat, because it's gonna automatically mute you back again. Because I'll let everybody unmute themselves. So if you were asking a question, you'll be able to answer and say, okay, I got it, or I didn't get it. And that's what was going on to the earlier people. Like it would mute you right back. So now we're gonna have to go back to that, because I don't want to continuously throw off the energy of the group. So if you up here and you ask your question and we're trying to answer you and we're trying to see if you understand, spam the chat to make sure we see if you didn't or did, so we can go ahead and continue, because I'm gonna have to lock it so y'all can't unmute yourselves. All right, so the person who was just up here, did you understand everything that I was saying? Oh yeah, so I was saying, like, if the people don't like to trade options on a stock that doesn't at least trade 1,000,000 times in a day. So that's the main thing. So all right. Appreciate it, Dimitri. All right. Rudolph, F, go ahead and ask your question.
Okay, Jordan, the question Jordan asked did answer my primary question, but I guess on the calculator that you guys advise to use, is there a strike price to cost maybe ratio that would help to know if you should enter a contract or not, or just go off your research and the numbers that you see in like the Greeks and so forth?
Hold on, let me unmute Kay to make sure she don't have anything. Kay, did you have anything on it? You can unmute yourself. All right, guess not, maybe. So when it comes to it, I just primarily go off my own research. I don't even worry about all that. I just see like where it's going to move, and I let my analysis dictate that. Like sometimes I'm comfortable in my instincts, so I just use that. I don't particularly myself really use options calculator that much, and it's like you get to a point where you don't necessarily have to. You kind of understand like how things move and how to select contracts. So I would just go off your research, and if
And
Kay has something to add to it, then she
I'm
can.
here. I'm sorry. I just had a call with Chris about the incident that just took place. And I'm so sorry. What was the question so that I can help you?
Well, I was saying the question that Jordan asked answered my primary question, but I guess the secondary question I had was, so when you do have a strike price and a premium price, when that premium price does start to rise, was there something on the calculator that would let you know that, hey, once it gets past this point, there's no point of entering this contract, because even if it does go up, you're not going to make any money anymore, or so forth? Or do you just have to go off the numbers in the Greeks and so forth?
Yeah, you would go off the numbers in the Greeks. The purpose of the options profit calculator is basically it shows you based upon your strike price and how much time you have remaining on your contract. If it were to go up, what you could potentially make, and if it were to go down, what you're losing.
Okay.
Yeah, and it'll show you in a graphic and a grid over time what it does. And it kind of gives you an idea of things. But for the most part, if you feel comfortable, because we don't know anything, if you feel comfortable that the stock is going to do that, then you can go ahead and still continue to do it. It's just at least you know over time what you would be losing every day. But also, like I was saying, factor in the implied volatility aspect.
Thank you.
All right, no problem. Um, KH2, go ahead and ask your question. You can unmute yourself.
I had a question regarding the break-even price. Is that like something that like what would be more important to focus on, or is it kind of just like you take everything in and make a determination? But is it more important to focus on like the break-even price? Are you more worried about like the stock hitting the strike price if you were doing like a call option?
The thing about that is, when it comes to break even, the break even just lets you know where the stock needs to be in order for you to break even on expiration. The strike price, oftentimes some people pick a strike price because they're expecting the contract to get that or go beyond that, because they might want to, exercise the contract and buy shares or whatnot. But for the most part, most people are just looking for a percentage gain. So they might pick a strike price, and sometimes it's because of the open interest in the volume, and they're just trying to look to get a 30%, 50% gain. So it doesn't even have to hit the strike price necessarily for them to make the profit that they're looking for. So I wouldn't say that the break even is something to concentrate on. The strike price is just what you're betting that the stock will get to. But oftentimes a lot of people don't necessarily care if it gets there, because they're just trying to make a quick 30 to 50%. Does that answer your question, Cage, too?
Yes, that does. Thank you guys so much.
No problem.
No problem.
Trade trades. Go ahead. Ask your question. You should be able to unmute yourself. All right. We're gonna go around you. Tanisha P, go ahead and ask your question.
Hello, can you guys hear me?
Yes.
Yes.
I just wanted to know if you could go over implied volatility one more time so I
Sure.
can get a better understanding of it.
Absolutely.
Thank you.
Think of that as the run-up, the anticipation around a stock making a particular move, right? So let's just say everybody knows that Nike is about to release a new shoe, Apple's about to release a new phone. It starts to draw traders in. So the implied volatility is essentially the run-up or the expectation around a particular stock making a particular move. Once the implied volatility begins to go up, so will, the changes in your contract, the premiums of your contract, the value of your contract, I should say. But once that implied volatility goes away, so will the value will begin to diminish in your contract as well. So that's something that you have to consider when you're trading, because the implied volatility makes a difference in the value of your contract going up or the volume of your or the value of your contract going down. Does that make sense?
Oh, my bad. Let me let her unmute herself. Does that make sense, Tanisha?
Yes, that does make sense. But and when you refer to volume, you do mean the number of people who are actually trading a stock within the day, correct?
Value, the value of your contract.
Oh, the value. Okay, thank you.
No problem.
All right, guys, we're gonna go ahead and end the call right here, because everything, and we will get back to you guys on the next call. And when we will have it again, we'll make sure that we continue having the presentation along with the you being able to ask your questions. Like again, apologize for everything. And
Before we go, I just want to address everybody and apologize. Please don't leave just yet, everybody. Let me just go ahead and explain to you what's going on. So obviously we had an issue, and we okay. Ray, pay attention to the chat.
yeah, I'm seeing it.
Okay, so obviously we're ending it because of the issue that we're having, but we are going to give you guys another opportunity to do the question and answer. So we apologize. We thoroughly apologize to the level of, not everyone was raised the same, right? And that's apparent. That's obvious. Not everybody was raised the same. And so that's the reason why we have to end it. So we apologize, but again, we're going to give you a platform to do your questions and answers, but we can't continue with people being disrespected. And I will say it's all love for all people, all sexual orientations, everyone in here. But again, we apologize. And you guys, in the meantime, please just go to Market Facts and Resources, scroll through the topics, a lot of your questions, literally a lot of this stuff, a majority of the stuff that you guys have asked us on this particular call is answered in that channel. I promise you, pretty much everything that you've asked on this call is in that channel. So sorry, you guys. So sorry. Love you guys. Love.
All right, and like I said, we appreciate y'all coming out. We had a big room, 1,000 people. So, thank you for your time, and hopefully, y'all learned a lot tonight. Got something from it besides hate. Love you, and we'll see you in the chat.